Hello everyone, Joel from Life in Nica here. Thanks for checking out this video again. And this one is, my spirits, this one is all about global financial and economic trends and then how they are affecting our local market here in Nicaragua and especially in the southern Pacific coast, like San Juan del Sur and the Tola area, as those are the main areas where foreigners are investing. So for the companion article to this one and then all the links, you can check that out over in the blog. And I guess the overarching theme for this one is that the cheap money hangover has begun to hit, but if you were able to avoid overindulging, you're doing just fine. Now, anecdotally for me, and then what I hear and research in the market here, and obviously abroad, is that the pandemic was a boom for real estate, right? The majority of my clients are from Canada and the States, and then some from Europe as well, but those booms, which were asset booms in stock prices and real estate, were due to monetary policy and quantitative easing, colloquially known as printing vast amounts of money. Now, I'll leave opinions on that aside, but obviously the printing of hitherto unseen amounts of money in such a short amount of time had those major effects, right? It devalues your currency and then it spawns that asset boom, right? So relatively speaking, things all go up like crazy, right? The stock market and real estate, those are, multi-trillion dollar increases, as you also saw multi-trillion dollar increases in central bank balance sheets, right? Now, in real estate, that led to a refinancing boom. And according to some data from Black Knight, a research firm, more than 40% of US mortgages were originated in 2020 or 2021. So think of that, 40% of all mortgages were originated in 2 years. When the pandemic drove down those borrowing costs to historic lows, and triggered a refinancing boom and a construction boom, as you can maybe hear behind me. According to the Mortgage Brokers Association of America, the average contract on a 30-year fixed rate mortgage increased by 9 basis points, 6.71% for the week ended in February 24th, according to the Mortgage Bankers Association. And from CNN Business, mortgage applications were down 5.7% for the week ending February 24th, and then rates trending higher. And then mortgage applications were down 44% from a year ago, and refinances are down 70%. But obviously that makes sense. If you go from a tiny rate to an extremely high rate very quickly, people aren't going to get new mortgages or refinance. And if you're locked in, you're probably not going to move because you don't want to lose that low rate. So some of this comes from CNN as well. And again, I've got all the links and a bunch of this research over in the article, so you can check that out over there. But the simple fact is that mortgage initiations have dropped off a cliff, right? And then rates right now even might be climbing again. There's news out as of yesterday that, Jerome Powell was going to increase the rates by looking like another 50 basis points. So if that continues to happen, you're just going to not see refinancing, you're going to not see new mortgage initiations. And that trickles down into Canada, that trickles into Europe, right? The US dollar is essentially the currency of the world, right? It's the Roman denarius. And that's but it does have some variable effects. Like in the southern states, some new sales continue to rise. But the further north you go, the worse things seem to get, basically, right? So in Canada, for example, it's from a recent article, Greater Toronto areas or GTA homes fell 18%. The average selling price was down 18%. Now that's still up since COVID, but obviously that's not great if you just bought a house and maxed out your cash. And the Toronto Regional Real Estate Board, it's a great name, said Friday that the average selling price for February totaled $1,095,000, or roughly 5% higher than the January price. Now that is ticking up, but a little bit of conflicting stuff there. But overall prices are still higher since COVID, but they're probably going to be going down. So, it's not like the banks pass along those rates to you, right? Like in 81, when Canada's interest rate peaked at more than 12%, you get some savings account that paid 19% interest rate. So you were getting, if you had money in the bank, you were actually getting some good interest rates, but basically the banks run the place, right? So, there's a reason why they don't lose money and they have all the assets in the world. So anyways, that's from a Globe and Mail article about that one. So yeah, banks are tightening up, people aren't going to refinance or move. And then that leads into how, what are those effects going to be on the market down here? Now, I actually had thought it was going to be slower. Part of that is, normally we're somewhat seasonal in terms of sales, right? Like everywhere else. And October, November, we're back to more of a normal sales volume, which we'd seen prior to COVID, because often people would fly down here and look at properties before they bought them. But during COVID, we were selling remotely. So back, in the I guess 2020, 2021, 2022, I mean, a lot of people were buying, with a video call and a live video walkthrough and drone shots and an inspection. But now, once again, people are coming back down. I've got a new article, US Airlines just returned to Nicaragua with direct flights. It's pretty easy to fly in and out of Liberia and Costa Rica and come up. So that actually, I thought we were gonna see more of a slowdown, but I think it was more of a return to the seasonal trends in when we get, when sales are initiating, right? That frenzied pace has essentially returned to earth. So, now that we're seeing that, and then in January, December, tourism picks up here, January it gets busier as well. And since January, we're back up to being quite busy. Again, anecdotally speaking, we don't have an MLS. I can't give you, exact numbers, but now that we're back in what is supposed to be the dry season, although we've been getting some rain, which is why it's still kind of green, people are coming back down. My personal sales volume is back up to, it's not peak COVID levels, but it's probably above pre-COVID still. Like this volume is good. And sales values are higher. Now, obviously that comes for a couple reasons, right? The value of the dollar is less, and the people that are buying aren't refinancing to buy, right? They have that liquid capital, which also tends to be more in the mid to upper tiers of the market, stuff like in Pacific Marlin up there behind me, or in the center of town, some of these condo buildings, etc. But mostly it's detached, single family. I mean, three pools, that'd be great. 3 bedrooms, pool, and an ocean view fairly close to town. So in terms of appreciation, again, we get the pluses and minuses of a market where we don't have much leverage, right? Interest rates here are so high that I don't even really go into them because nobody gets a mortgage here. So it means basically everybody's cash purchases. So that has a couple, that has positives and negatives, right? You don't get the huge boom in your real estate values, especially when you're leveraged, that cash on cash return is much higher. We don't get that here, but we also don't get the crazy valleys because nobody's leveraged, nobody's mortgaged. There's no rush for the exit, so to speak. And nobody finds themselves like underwater on a mortgage or unable to move because they can't refinance. Like everybody here owns their property, right? If things go sideways for me, the market goes bad, I'll just hold until things get better, right? So because of those two factors, what we generally see is, appreciation, tracking inflation, maybe a little higher. Now, given those trends in the States where we're seeing markets like Miami and Tampa, Florida and southern states, still high demand, prices are actually still going up, whereas they're going down in northern states. Could we get, more appreciation? Yeah, it's possible, but like conservatively, sorry, I got cut off by the dog there. Conservatively speaking, I mean, what would I expect in the way of, price appreciation here? I mean, it generally tracks inflation, right? Because inflation is going to be your base cost of materials for any new builds, right? Concrete and rebar. And then could we see more appreciation in that? Yeah, I would say it's, fairly likely, a few points more. Could we see it dramatically higher than that? I mean, I don't think so, but then again, we're still seeing markets like Florida, the southern states, specifically Florida, they're still seeing, appreciation and growth. And I think that's part of the shift moving south, right? That remote work trend is maybe, ebbs and flows a little bit. I think maybe it's going back a little bit as maybe people return to the office, but that in a lot of cases, people can work remotely. So I think in terms of appreciation here, tracking inflation and a few points higher is fairly likely, right? That's chances are that's what we're going to see. So, I would expect, solid sales volume. Again, not the frenzied pace of COVID, but I think we'll do well. So, overall, we're not leveraged. There's no rush for the exits. We're still an attractive community. The school, a bunch of the other stuff I talk about in blog articles, those attractions to here don't go away. The surfing, which is like living next to, a ski resort, right? That natural geographic feature isn't going anywhere. In fact, outdoor activities like that probably going to increase in popularity. So I would expect moderate sales, moderate to, moderate sales levels, sales volume, prices appreciating at or above inflation. And yeah, I think overall we're going to continue to do well here, but it's more of a normal market again, not the insanity of COVID. And yeah, I mean, we actually didn't see crazy increases in prices even during COVID because we had a rare combination of high demand and high supply at the same time, right? A lot of people were selling that just only bought it to be an Airbnb, and then they are, the buyers were all coming down to live in them or, work from, retire from, live here and live in the community, etc. So yeah, I mean, those are my overall impressions. And once again, you can check all the links out and all the resources out over in the companion article of this one. So I hope this was helpful for you. Thank you very much for watching if you got this far, and have a great day.